Welcome to our last video lecture on Chapter 4, covering the income statement, other comprehensive income, and statement of cash flows. Our seventh learning objective, we are now moving towards the statement of cash flow and its purpose. So what the statement of cash flow does is it provides you with the details of the cash receipts and the cash disbursements, and basically during the period. So it tells us how much money we got in from customers and how much money we spent on vendors and others. Cash, we say it's cash and cash equivalents, and remember, cash equivalents is converted into cash in the next 90 days. So here we're doing it for each period, and it basically tells us a lot of information. It tells us how profitable we are, how liquid the company is, and its long-term solvency. Obviously, operating activities is one of the crucial ones. If we're making money from operating activities, which usually is the sales of goods and services, then that's great. So we have operating, investing, and financing activities, and they are presented in this order: operating, investing, and financing. Note that operating activities is from the normal sale of goods and services. So now what we want to do is look at each of the classifications and of the cash flow and how it's presented. So for operating activities, these usually we have inflows that come from the sale and any interest, and dividends from investments. So this is a special item that you need to remember. Sale of goods and services is pretty easy, but here we're looking for interest and dividends from investment. That is included in operating activities. What we normally spend money on is inventory, salary, wages, and income taxes. Also make note of income taxes. So basically what we have here, the net cash flow from operating activities is our differences from what we bring in to what we spend. So now let's take a pause here and look at this concept check. Which of the following items would not be included as cash flow from operating activities in the statement of cash flows? Give you a second to formulate your answer. Hopefully you picked machinery, because that would be in investing activities, which we're going to talk about in a moment. There are two ways to present operating activities. Operating activities are the only activity that is presented in two ways: the direct method or the indirect method. And GAAP prefers the direct method, but most companies use the indirect method because we start with net income. So what the direct method is actually tells you the cash effect of each activity. What the indirect method is, it takes your net income and reconciles it by adding and subtracting items that are going to convert your net income, which is in an accrual basis, to your cash basis. So here we see basically our income statement and our balance sheets, and we need this information to go ahead and prepare our two formats. So in the direct method, we take our accounts receivable balance and we take our revenue, and then we're actually trying to come up with this amount here of 78. So usually when you have beginning balance plus revenues and then minus your cash receipts. So that is basically how we compute our cash received from customers. And then the indirect method, we start with net income and then we add depreciation expense, because depreciation expense is a non-cash item. And then what we do is we take the changes in our operating assets and liability. So we would actually look at our change in accounts receivable to get that portion. So now for investing activities, same thing, we're looking at inflows and outflows of cash, but here it's for acquiring and disposing of long-lived assets. So here, the purchase and sale of inventory, that is not investing activity, that is an operating activity, correct? In investing activity, we're looking at long-lived assets. So here what we have are outflows, maybe when we're buying long-lived assets or fixed assets. Maybe we're looking to purchase investment securities. We're probably giving out loans. We might sell our fixed assets. We might sell our investments. We might collect on a non-trade receivable. But note, the interest that we are collecting on that is an operating activity. Do not forget that. That is a common pitfall for students. Remember, interest is part of your operating activity, but the actual non-trade receivable, that's part of your investing activity. So other than those classified as cash equivalent and trading securities, so when you're looking at investments, you're not looking at cash equivalents and you're not looking at trading securities. You're looking now here mostly to held to maturity and securities available for sale. Now, financing activity relates to the external financing. So if you think of assets equals liabilities plus owner's equity, debt is a financing activity and common stock or stock, right? So these are the two formats of financing activity. So here you might get money from owners or from creditors where you're borrowing. So that's your debt, and then owners is your equity. Then your outflows, you might actually pay dividends. And you might actually reacquire shares. That would be treasury. Stock, so that would go here in financing activity. You might repay the payment of the principal. But remember, the trade payables, right? AP is part of operating activities. So anything that doesn't involve cash, usually you kind of report that on the face of the statement of the cash flows. So if you're you're acquiring a piece of equipment, but you're issuing a long-term note or an equity security, you would actually just put those details right on the face of the financial statement, of the statement of cash flows. And now you'll see here we have cash flows. Oops, let's go back. Oh, we have cash flows from investing activities, and we have cash flows from financing activities. And we see the investment activity is we actually purchase equipment, and financing activities we have common stock and the payment of dividends. Note, the payment of dividends is part of financing activities. Then you see we have your net cash flows, and then the total of the three: operating, investing, and financing. That gives you your net increase in cash. You add to that your beginning balance, and this ending balance should be on your balance sheet. If this equals your balance sheet, you've done it correctly. Now, the last learning objective that we're going to talk about in Chapter 4 is, again, the differences between GAAP and IFRS and as they relate to income statements, OCI, other comprehensive income, and the statement of cash flows. So you'll see in GAAP, we don't have minimum requirements. We do have the way that the SEC tells us to classify expenses is by function, and we have our bottom line, whereas there are certain minimum information for IFRS, same thing for comprehensive income and for cash flows. The key with cash flows is we have operating, investing, and financing. A note, the differences, our dividends are in operating activities, but in investing in IFRS, and so is the interest. So those are classified differently. And then here, interest paid is part of financing activity when it isn't for GAAP. So please make note of that. This will help you in your preparation towards the CPA exam. And that concludes our video lectures for Chapter 4. Hope you found them useful.